Hello and welcome. In this lecture video, I will be doing journal entries associated with job order costing. So the last journal entry we did was talking about using raw materials. And we were going through and talking about the accounting equation, saying raw materials is an asset. So we're moving raw materials from the raw materials asset account to the work in process asset account. The direct materials. The indirect materials move from raw materials to manufacturing overhead. And manufacturing overhead is just a temporary, the way I want you to think about it is it's a temporary area where we hold our manufacturing overhead expenses. Okay? The journal entry to use raw materials, debit WIP, debit manufacturing overhead, and credit raw materials. Now let's talk about the journal entry for recording factory labor. Okay, so similar to what we talked about with our materials, our direct labor goes to work in process, indirect labor goes to manufacturing overhead. So I will debit work in process, debit WIP for direct labor of $28,000. I will debit manufacturing overhead for my indirect labor of $17,000. And then it doesn't say anything about paying the labor costs. So it's just incurring the labor costs. So I will credit my liability of wages payable for the summation of those two, $45,000. Okay? Let's look at number 4, paid the $45,000 of labor costs. So in terms of journal entries, we're paying this wages payable. We're paying off this wages payable. What do we pay things with? Cash. That means cash is going down. Where do we put cash in terms of the accounting equation? Cash is an asset. Cash is going down. Assets are going down. How do I recognize that in terms of debits and credits? Credit. So it's a credit to cash. Wages payable. Where do we put wages payable in terms of the accounting equation? It's a liability. My liability is going down because I'm paying off my liability. It's decreasing, kind of like you paying off your credit card. You don't have that credit card debt anymore. How do I recognize that my liability is going down? With a debit. So my journal entry is debit to wages payable, $45,000, credit to cash, $45,000. Okay? Let's look at the next one, number 5, depreciation on sales office equipment. So there's a couple things that we need to know about this one. The first one is that, sales. That means that this is a period cost, period expense, not a product expense. This does not go to manufacturing overhead. This does not go to cost of goods sold or finished goods. This does not go to inventory. It is a period cost. Okay, so that's important to remember because it's not going to come into manufacturing overhead because it's sales, which means it's period. All right. The second question is, what is the journal entry to record depreciation? You should remember it's a debit to depreciation expense, credit to accumulated depreciation. How does that fit in terms of our accounting equation? Depreciation is an expense, and the way that I increase an expense is with the debit. Why do I increase an expense with the debit? It's because expenses, as expenses go up, equity, the E stands for equity, remember, expenses go down. So how do I recognize equity, as expenses go up, equity goes down. How do I recognize that equity goes down with a debit? So to increase an expense, I debit the expense, and the reason that I debit the expense is because expenses decrease equity, and the way to decrease equity is with the debit. So I will debit depreciation expense $3,200. And then you should remember that the credit goes to accumulated depreciation. $3,200. So let's look at this again in terms of the accounting equation. Depreciation expense, expenses go up, equity goes down. So this side of the equation goes down because equity went down, and equity went down because expenses went up. Accumulated depreciation is a contra asset account. So as accumulated depreciation goes up, the book value of our assets goes down. So our book value of our assets goes down because accumulated depreciation went up. Remember, the way to calculate book value is asset cost minus accumulated depreciation. So as accumulated depreciation goes up, you're subtracting a bigger number from the asset costs, which then decreases the book value of your assets. So the book value of our assets goes down and equity goes down because expenses went up, and then the accounting equation stays in balance. Okay? Let's look at this next one. Other factory overhead costs incurred. Factory insurance expired, $1,000. Depreciation on factory machinery, $4,500. And then utilities for factory, $2,200. Okay? The key word is factory. What that's telling you is that this is manufacturing overhead. This is not a period cost. This is manufacturing overhead. Okay? So what we can do is we can add up all of these, and we can debit manufacturing overhead for the sum of all these, because they all go to overhead, because it says so right there. Okay? So 1,000 plus 4,500 plus the 2,200, we debit manufacturing overhead, MOH, for $7,700. Okay? Now, factory insurance expired. This is prepaid insurance. That's what that's telling you. So remember, the journal entry to record the expiration of prepaid insurance is debit insurance expense, and that's included in here. It's just that it's not broken out between manufacturing overhead, comma, insurance expense. Although you could think of it that way, and a company could track it at that level of detail. It's just for the purposes of this journal entry, we're just putting it straight to manufacturing overhead. But keep in mind, they could say manufacturing overhead, comma, insurance expense. That's fine. It just has to go to manufacturing overhead. Okay? So, but getting back to the insurance expired, the journal entry to record the expiration of prepaid insurance is debit insurance expense, credit prepaid insurance. The debit is wrapped up in this number. So then what we have to do is credit prepaid insurance for our $1,000. And then we have depreciation on factory machinery. We know the credit goes to accumulated depreciation. And then we have our utilities for the factory. Doesn't say paid, so it just goes to utilities payable. $2,200. And that's our full journal entry. Okay? So let's look at number 7. It says factory overhead is applied at 35% of direct labor costs. This is our predetermined overhead rate. So in this problem, I'm giving you the predetermined overhead rate. So what this is telling you is that we apply 35 cents of overhead for every dollar of direct labor. We apply 35 cents of overhead for every dollar of direct labor. So you have to say, well, how much direct labor did we have? We had this much right up here this $28,000. That's how much direct labor we had. You can see it right there. So we have $28,000 of direct labor. So the first thing we have to do is calculate how much overhead we will apply. 28,000 times our predetermined overhead rate. This is how much direct labor we had, times our predetermined overhead rate of 35% or 35 cents for every dollar of direct labor, gives us $9,800. Okay? The journal entry to apply overhead is debit work in process, credit manufacturing overhead. That is the journal entry to apply overhead. Debit work in process, credit manufacturing overhead. So basically what we're doing is we're collecting all of our overhead costs and manufacturing overhead. And then what we do is we move some of the overhead costs out of overhead to work in process. How much do we move? It's based upon our predetermined overhead rate. Okay? In this case, it's given to us. The way I kind of think of this is almost like, I'll turn the page over here. I've got a bucket, and this is my manufacturing overhead bucket like this. And then I've got job 101 and job 102. Now, all these costs, all these indirect costs that are associated with making jobs 101 and 102 are indirect materials, indirect labor, all that stuff, and other factory overhead costs are included in here because I can't directly trace it to these two jobs because it's indirect. So what I have to do is dump out some of that bucket into job 101 and job 102. And that pouring out some of the bucket, just bear with me, the bucket of all the costs that are being held in manufacturing overhead, pouring out some of that bucket into job 101 and 102. How much goes to these two different jobs? It depends upon the allocation base. Okay? How much of the allocation base job 101 used? How much of the allocation base job 102 used? And then what we do is we multiply that allocation base times our manufacturing overhead rate, and then that's how much goes into job 101 and job 102. And in terms of the journal entries, we put it to WIP, work in process. That's where we apply it. And then we credit manufacturing overhead. Crediting manufacturing overhead reduces how much is in the bucket here, and debiting WIP moves some of it over here. Okay? So that's the way I like to think about this, and hopefully that helps you. And that's the way I used to think about it when I would be working in industry and we would have to track overhead and then apply it to different task orders, which is almost like a job. Okay? So the journal entry is a debit to WIP, credit to manufacturing overhead. And why do we debit WIP? Well, the balance in WIP, work in process, is going up. Work in process is an asset account. How do I increase an asset with a debit? Okay? Let's look at these last two. Last three, sales, staff, and travel costs were incurred. $4,500. That's a period cost that does not go to overhead. So we would debit sales, travel, expenses, $4,500. And then we would credit accounts payable, $4,500. Okay. Cost of the jobs completed. So when a job is completed, it moves from work in process to finished goods. These are both asset accounts. This asset account is increasing. This asset account is decreasing. So it becomes a debit to finished goods and then a credit to work in process. In the next lecture video, we will continue on with more journal entries. Thank you.